Usually, when a government drops a pretty punishing 60% tax on foreign property buyers, you'd expect a housing market to cool down.
Oh, absolutely. You'd expect investors to just pack up and look for cheaper pastures somewhere else.
Right. But in the first 3 months of 2026, a staggering $15.4 billion flooded into Singapore real estate anyway.
Which is, I mean, it's an astronomical 166.5% jump from the exact same quarter in 2025. It completely defies standard market gravity.
It really does. So, welcome to the deep dive. Today, we're following that massive $15.4 billion money trail.
And we've got a huge stack of fresh Q1 data to go through, too.
Yeah, we have official transaction records from the URA, deep dive market analyses from ERA and EdgeProp, plus, GLS tender results and commercial reports.
Yeah, from the Business Times and 99.eho, it's a lot of material.
It is. And our mission today is to figure out where the smart money is actually going right now. Because whether you are actively managing a portfolio or you're just looking to deploy capital smartly, we want to cut through the noise for you.
Exactly. We need to look at the actual mechanisms driving this. Because just looking at surface-level numbers, well, it isn't enough anymore.
Right. Okay, so let's unpack this, because the scale of this influx is just, it's hard to wrap your head around.
Yeah, billions with a B.
Yeah. To figure out where this money is going, I want to start by looking at who is actually writing these checks. Because last year, 2025, was already massive.
It was. We saw over 10,815 new private homes sold. That was a 67.2% jump from 2024.
Right. And that momentum hasn't just carried over, it's kind of mutated. Like, are we just seeing thousands of individual buyers upgrading their homes?
We're seeing some of that, sure. But the real driver, the reason we are talking about billions, is institutional capital making incredibly calculated moves.
Oh, really? Like who?
Well, for instance, Capital Land Investment recently secured a $2.4 billion mandate from income insurance.
Wow, okay.
Yeah, and then you have Hong Kong Land quietly acquiring a 10.8% stake in Suntec REIT for over $541 million.
So these aren't just families looking for a condo near a good primary school. These are massive funds.
Exactly. Massive, sophisticated funds.
But I have a theory about this, and I want to see if it holds up. You look at escalating geopolitical tensions in the Middle East, shifting global tariff policies. Is this $15.4 billion just panic money?
Panic money.
Yeah, like, are these institutions just looking for a political safe haven and blindly parking their cash under the proverbial Singapore mattress, just completely regardless of the returns they get?
I wouldn't freeze it quite like that. I mean, the safe haven aspect definitely gets them in the door, but this is absolutely not blind panic buying.
Okay, so they still care about the yield.
Oh, heavily. Capital deployment at this level is ruthless about asset type preference and expected yields. The days of speculative frenzy are over.
Like when an investor could buy almost any random property and expect it to appreciate 10% in a year.
Exactly. Those days are entirely gone. This is highly calculated asset allocation.
So they aren't just treating Singapore real estate like a giant concrete savings account.
Far from it. They demand stability, yes, but they still require aggressive performance. They are hunting for very specific types of value.
Which means they are completely ignoring large swaths of the market while pouring billions into others.
Right. It's a very bifurcated market right now.
Okay, if they're being that picky, then let's look at the developers, because the developers are the ones who have to interpret this demand and actually build the supply, right?
Yeah, they're on the front lines of this.
So where are they placing their bets? I was looking at the latest government land sales, the GLS results, from the first quarter, and the numbers out in the suburbs are wild.
You're talking about the OCR, the outside central region?
Yeah, like the Lentor Central site. It just closed with 5 aggressive bids.
Right, one by Guaco Land, Intrepid, and TID for $657.1 million. That translates to $257.1 million. That translates to $1,278 per square foot per plot ratio.
Wait, slow down. Let's unpack that metric for a second because it's crucial. For those of us who don't work at a property developer, per square foot per plot ratio isn't just the cost of the dirt, right?
No, not exactly.
It's basically a metric of how much you're legally allowed to build on that dirt.
That's the perfect way to look at it, yeah. If you buy a $10 million plot of land, but the government's plot ratio only allows you to build a 3-story building, your land cost per sellable unit is incredibly high.
Right, because you only have a few units to sell.
Exactly. But if the plot ratio allows a 30-story tower on that exact same plot, Your land cost is distributed across many more units.
Ah, okay. So per square foot per plot ratio is like the ultimate standardized metric developers use to calculate their true raw material cost.
Yes, before they even pour a single drop of concrete.
Hmm.
And $12,278 on that metric is historically huge for a suburban area.
It is. And we saw the same thing in the rest of Central Region, right? The Tinjongru Road site.
Oh yeah, 5 bids there too. CDL Constellation and Bedrock Ventures won it at $709.3 million.
Which is what, like $1,455 per square foot per plot ratio?
Yes, a record for that region. And it's the first GLS in that area in over a decade.
That's insane. But wait, getting back to Lentor for a second, I remember Lentor being the absolute poster child for oversupply fears just last year.
Oh, people were terrified.
Yeah, analysts thought developers were building a ghost town. What changed?
Well, the pipeline reality set in. While everyone was worried about a temporary glut in Lentor, the developers were looking ahead.
Looking at what? The future land releases.
Exactly. The confirmed future land releases for the entire outside central region for the rest of 2026. And that pipeline is actually incredibly thin.
Ah, so they aren't paying a premium because they think Lentor is magically more valuable today.
No, they're paying a premium because they know severe scarcity is coming tomorrow. They are pricing in that future scarcity.
Oh, wow.
Plus, they're looking at the fact that 4 out of the 6 past launches in Lentor are now completely sold out.
So the whole oversupply narrative was just a mirage.
Basically, yeah. Developers are securing land inventory now before the competition for suburban plots gets even fiercer.
And analysts are projecting what for the new Lentor condo, like $2,700 per square foot?
Yes, that's the projected launch price.
Okay, here is where it gets really fascinating to me. We are seeing these record land bids and sold-out launches in the suburban OCR market. But if you look at the core central region, the CCR.
The traditional luxury playground, District 9, 10, and 11.
Exactly. It's telling the exact opposite story. District 9 prices actually fell 3.2% in the first quarter of 2026.
It feels like an upside-down market, doesn't it?
It really does. The suburbs are booming, and the prime luxury districts are dropping in value.
It goes right back to that 60% additional buyer stamp duty, the ABSD, on foreigners that we mentioned at the start.
Because the CCR historically relied heavily on foreign wealth.
Exactly. When the government effectively walled off that buyer pool, it neutralized a huge chunk of the speculative demand that used to drive those prime district prices.
That makes sense. And the rental yields in District 9 aren't helping either, right?
Yeah.
They're sitting at a rather risky 2.1%.
Yeah, 2.1% is tough.
Which means if you take out a mortgage right now at current interest rates, you are actively losing money every single month on a prime luxury condo.
You're deeply in the red. But I want to add a caveat here because the market is highly fragmented.
What do you mean?
Well, at the exact same time average prices in District 9 are falling, an ultra-luxury project like Newport Residences in the CBD launched.
Oh, I saw that. They sold 57% of their units right out of the gate.
Yes, at over $3,370 per square foot.
Okay, how does that make any sense? If the luxury market is suffering, who is buying a brand new CBD unit at that price?
The ultra-wealthy buyers who are entirely immune to standard borrowing costs, they aren't looking for monthly rental yield.
Right, they're buying with cash.
Exactly. They are buying for trophy value, freehold status, and long-term capital preservation in a major transformation zone. It's a completely different rule book for them.
Okay, so if the standard luxury residential market is upside down and residential yields are squashed down to 2%, what happens to the capital that still wants income?
They pivot.
Like, if I'm an investor and I don't want to pay a 20% ABSD tax for a second residential property, but I still want my money working in real estate, where do I go?
You rotate out of residential entirely. The data shows a massive capital rotation happening right now into physical commercial assets and REITs.
Let's talk about the physical commercial side first, because the numbers here really stood out to me.
Sure, they're quite striking.
Yeah, our sources highlight a specific property at 237 Cantonment Road. It's a freehold heritage hospitality asset, essentially a boutique commercial space.
And the asking price is $17.8 million.
Right, and it's projecting a 4.5% yield. That's massive compared to residential.
Yeah, you contrast that 4.5% yield with the 1.8 to 2.5% yield you might get from a suburban landed home right now. The math is night and day.
And more importantly, commercial properties completely bypass the residential ABSD, right?
Exactly. You don't pay that massive tax penalty just because it's your second or third property.
That's a huge advantage.
It is. Investors are incredibly hungry for these rare income-generating conservation properties like shophouses because they offer yield and historical scarcity. Same goes for a Juche 4-story shophouse that's up for $11.5 million.
But let's be real. You and I probably don't have $17 million lying around to casually pick up a heritage property on Cantonment Road.
No, unfortunately not.
So retail investors, the everyday people, they are looking at S-REITs, the Singapore Real Estate Investment Trusts.
That makes sense as an accessible entry point.
It does, but this is where the market behavior genuinely confuses me. Retail investors poured $300 million into S-REITs in March 2026 alone.
And they did that even though the broader iEdge S-Rate Index posted a negative 6.4% total return for the first quarter.
Right. Capital and Ascendus REIT saw almost $197.7 million of those retail inflows all by itself.
It's a massive amount of capital.
So help me understand this. Retail investors are pouring hundreds of millions of dollars into REITs that are actively bleeding value on paper. Are they just trying to catch a falling knife?
Well, I assume you're thinking about interest rates.
Yeah, like if global rates drop, does that automatically make REITs more valuable? Is it just the ultimate buy-the-dip strategy?
It's a major factor, yes. REITs and interest rates have a classic inverse relationship because REITs use a lot of debt to buy properties. High interest rates eat directly into their profits.
Right. The debt gets more expensive.
Exactly. The retail investors pouring money in right now are essentially playing a macro game. They are betting that central banks will eventually cut interest rates.
Which would widen the REIT's profit margins and cause their unit prices to rebound?
Yes. But to answer your question about catching a falling knife, if they were only looking at interest rates, then yes, it's risky. But the savvy investors are looking past the short-term noise.
Looking at what exactly?
The underlying assets and long-term operational health. A lot of these REITs have suffered from something called equity dilution recently.
Which is when a REIT issues a bunch of new shares to raise cash, right?
Yes. Think of a REIT like a pie. If they issue new shares, they are cutting the pie into more slices. Your individual slice just got smaller, which is why the unit price drops.
That makes sense.
Now, if the REIT uses that cash to buy a highly profitable new property, let's say they add a bigger pie to the table, then over time, your dividends go up. We call that an accretive acquisition.
So it's like a successful restaurant opening a new branch. It costs money up front. Maybe the original owners take a hit, but eventually the new branch brings in more total profit.
That's a great analogy. But if the REIT is issuing new shares just to pay down its existing expensive debt just to stay afloat, then they aren't adding a new pie to the table.
They're just slicing the existing pie thinner.
Exactly. That is deeply non-accretive. And that's the danger for retail investors right now. Buying the dip only works if it doesn't turn into a deeper decline.
So you have to look at the specific REITs.
Right. Investors are looking at a trust, like Fraser Centerpoint Trust. It's defensive. It focuses on suburban malls in Singapore. That's essential heartland spending.
Because people still buy groceries regardless of global stock markets.
Exactly. The underlying cash flow is rock solid. While something like Keppel REIT offers prime office exposure despite dilution headwinds, retail investors view the current low unit prices as a temporary discount.
Okay, so if commercial real estate and S-REITs are where the yield-hungry capital is hiding, what happens to the people trapped in aging residential properties who miss this boat?
The en bloc market.
Yeah. For a long time, if you owned an older condo and your rental yields dried up, your exit strategy was the en bloc sale, right? A developer buys the entire complex, tears it down, and you walk away with a massive life-changing capital windfall.
The en bloc dream. It's the ultimate exit strategy. But the reality on the ground in Q2 2026 is that the en bloc mechanism is facing severe friction.
It's certainly not for a lack of trying. I mean, the sources show massive listings out there.
Huge listings.
Yeah, Singhai just bought Loyang Valley for $880 million, which is the largest since Thompson View. And the Tan Boon Liat building is trying again at $1 billion. Serenity Park in Yeo Chu Kang is listed at $505 million.
The product is there, and the owners clearly want to cash out.
So why is the system stalling?
Because the headwinds for developers trying to buy these mega sites are mounting aggressively. And it starts with the Land Betterment Charge, or LBC.
I saw this in the data. The government hiked the LBC rates for the March to August 2026 period, But why did they do that? And what does it actually do to a developer's math?
Well, what's fascinating here is how it connects to the aging condos.
Mm-hmm.
The LBC is essentially a tax a developer pays to the government for the right to enhance land use.
Like tearing down a 10-story condo to build a 30-story condo.
Exactly. The government wants a cut of that newly created value. In Sector 97, which covers parts of Bedok and Tanamera, the government spiked the residential LBC rate by an incredible 22.7%.
Wow, wait, 22.7%. So before a developer even pays the condo owners, they suddenly owe the government nearly a quarter more just for the permission to redevelop.
Yes, that massive fee eats directly into the developer's profit margin. And because their margin is squeezed, they can't offer the condo owners the massive premium they are expecting. The math simply fails.
Add that to the fact that developers are already under the gun with the ABSD rules, right?
Oh, absolutely. They have a strict 5-year window to build and sell every single unit in a new project, or they face absolutely crushing corporate tax penalties.
Which explains why taking on a massive en-bloc site right now is incredibly risky.
It is. But the squeeze isn't just on the developers. The government is also aggressively tightening the screws on the individual residential investors through policy enforcement.
Right. IRAS, the Inland Revenue Authority of Singapore, they are currently conducting heavy audits on landlords for undeclared rental income.
Yes, and more importantly, they are aggressively prosecuting 99-to-1 ABSD avoidance schemes.
I find this crackdown fascinating. For anyone listening who is unfamiliar, the 99-to-1 scheme was essentially a popular loophole.
It was everywhere.
It's like sneaking into a movie theater. One person, usually a first-time buyer with no ABSD tax liability, buys 99% of the property to get past the tax bouncer at the door.
Right.
Then right after, they sell 1% to their spouse who already owns property, just so the spouse's income can be used to secure a much larger bank loan.
That's a great way to visualize it.
Yeah.
And for a long time, the market treated it like a clever, accepted loophole. But IRS is finally checking ticket stubs.
They're treating it as deliberate tax evasion now.
They are going back years, auditing the paper trails and slapping owners with the back taxes, plus massive punitive surcharges.
It sounds like the entire residential investment landscape is stuck in a vice grip. You have aging condos facing rising maintenance costs, making owners desperate to sell en bloc.
Yes.
But developers can't buy them because of 22% LBC hikes and 5-year ABSD deadlines, and individual investors can't maneuver because of massive tax audits.
It is systemic friction. There's been a lot of industry talk lately about the government potentially lowering the unblock consent threshold, meaning requiring fewer than 80% of the owners to agree to a sale.
But based on what you're saying about the developer's math, lowering the voting threshold won't magically save the market.
No, it won't.
I mean, it doesn't matter if 100% of the condo owners want to sell if the developer simply cannot make a profit after paying the LBC and taking on the development risk.
Exactly. It doesn't solve the core financial barrier. Which brings us full circle to why we saw developers fight so aggressively for the Lentor and Tanjong Rhu GLS sites we talked about earlier.
Because the barrier to entry is lower.
Right. With a government land sale, it's a clean slate. You don't have to herd hundreds of squabbling condo owners to get a consensus. You bid, you win, you build. It is a much safer, more predictable deployment of capital.
So what does this all mean? We've tracked the billions of dollars flowing into the market. We've mapped out the upside-down luxury sector, the pivot to commercial yields, and the slow death of the en-bloc dream.
It's a completely transformed landscape.
It really is. So let's distill this entire stack of Q1 data into highly actionable takeaways for you, the listener. Based strictly on our sources today, let's look at the top 2 opportunities and the top risk to watch this week.
Okay, for the first opportunity, look toward heritage and boutique commercial assets. Specifically, freehold shophouses and hospitality assets like the Cantonment Road listing we discussed.
Because of the yield.
Yes, they offer around 4.5% yields, they completely bypass the punitive residential ABSD, and they benefit from long-term master plan tailwinds, like the Greater Southern Waterfront. They offer both scarcity and immediate performance.
Great. The second opportunity to watch is what we're calling OCR residential scarcity. With a very thin confirmed pipeline of government land sales for the rest of 2026 in the outside central region, existing integrated projects are looking good.
Yes, projects in suburban areas like Lentor are proving to be highly resilient capital gain opportunities.
Right, because the early oversupply fears were just wrong. For HDB upgraders looking to transition into private housing, the scarcity reality is setting in, making these suburban hubs strong capital gain plays.
As for the top risk to watch this week, It is undeniably the regulatory and tax squeeze on residential investors.
The margin for error is basically zero now.
Absolutely zero. Between the massive land betterment charge hikes destroying en bloc premiums and IRS's severe retroactive crackdown on 99-to-1 schemes and rental income reporting, you have to be flawless.
For amateur residential landlords, ignorance is no longer a defense.
No, you must ensure your holding structures and income reporting are pristine, or the penalties will instantly wipe out years of yield.
The days of casual, slipshod property investing are definitively over.
Which leads me to one final thought for you to mull over.
Oh, let's hear her.
We've discussed $15.4 billion of institutional money flooding into Singapore as a strategic haven, while everyday retail investors are pouring hundreds of millions into S-REITs just to chase yield.
Right.
What we are really witnessing is the massive financialization of the property market. If giant institutional funds and private equity start completely dominating the physical commercial spaces in the high-end residential markets, it raises a profound systemic question.
Which is?
Will the everyday Singaporean investor eventually be completely priced out of direct physical property ownership? Are we moving toward a future where buying shares in a REIT is the only viable path for the average person to participate in real estate investment?
Wow. That is a fascinating and slightly sobering question to end on. If the entry price for physical real estate keeps climbing, paper real estate really might be the only door left open.
It's definitely something to watch.
Well, thank you for joining us on this deep dive into the Q2 property landscape. Keep an eye on those yields. Make sure your tax structures are rock solid, and we'll catch you on the next one.